So I'm delighted to be here today. My name is Chris Tran. I'm the head of Northridge Partners. We are the technology specialists for Southeast Asia, and we look after Series B plus companies in terms of strategy, fundraising, and exit via M&A or IPO. I'm very pleased to be joined here on stage with me, Alice from Jungle, T from Kura, Teaser from Colibra, and Vadim from Vickers Ventures. I'll start off with a self-introduction and they'll tell you a little bit about their funds and I think that's the best way to get rolling. So, Alice.
Hello, yes. Hi everyone, I'm Alice. I am working as a senior associate with Jungle Ventures. We are a Southeast Asia-based VC firm investing at Series A and Series B. We've started this back in 2012 and currently fundraising our third fund, a 2019 vintage. We are investing at, within a few verticals, which would be fintech, e-commerce, marketplaces, and software, and actually trying to help entrepreneurs in this region to scale in Southeast Asia and globally.
Great, thank you. T?
All right. Hi everyone, my name is T. I'm a managing partner of Kuru Partners. We are a multi-asset, thematically driven investment firm, and I'll be heading our venture effort. I was previously with a firm called Ventura Capital, which is an early stage venture fund focusing in Southeast Asia. And right now under Kuru, we are working to launch also a new early stage fund focusing on Series A.
Teaser?
Hello everyone, my name is Tizar. I'm a managing partner for the Colibra Capital. Colibra Capital actually focuses on Indonesian startup and also global startup that would like to enter Indonesia. But I think what differentiates Colibra, perhaps because the founding partners of our fund, aside from myself, the finance professional, we have Leon, which is actually the co-founder of Tokopedia.com, one of the unicorn in Indonesia, and also the Nara from Ciputra family. So the idea is really to combine the three skill set, the financial professional and also the know-how from the unicorn startup entrepreneur, and also from the wisdom from the family business in Indonesia. So the goal is actually to be the one-stop shopping for global startups who want to actually expand to Indonesia.
Vadim.
Hello, I'm Vadim. I work for Vickers Venture. Vickers Venture is the largest and the oldest venture capital firm in Singapore. We manage roughly 3.2 billion together with co-investments, investing globally, roughly 1/3 China, 1/3 Southeast Asia, 1/3 rest of the world, through 7 offices, focusing on deep tech, like all these trendy words like AI, machine learning, biotech, regenerative medicine. We like complicated stuff because we have smart people to analyze this complicated stuff. 8 team members have PhD in different verticals, nanotechnology PhD, IT PhD, biotech PhD. So these people are able to look under the hood to actually analyze this technology. We are early stage, so our initial ticket is 3 to 5 million, but we are ready to follow up our own portfolio companies. So despite the fact that we are calling ourselves a venture fund, we're actually a hybrid fund because half of the fund is the later stage deals from our early portfolio. So our largest company is a $12 billion valuation, so it's not VC type at all. But we're happy to continue investing in this company because we are expecting another 10x from it. So this is roughly a brief description of Vickers Venture.
Thank you very much, and we're very lucky because each and every one of these GPs have had active investment experience in either centaurs and or actual unicorns. So I think it's very important when we look at fundraising, and particularly fundraising and getting ready for that dollar in VC land, what do the investors think about? Put yourself in the investor's shoes. What do the founders not think enough about in terms of what the investors are worried about? So I might start with you, Alice. What keeps you up at night? What sort of you wish the people that were pitching to you were more cognizant of in terms of what you need to go through for IC and to really lobby and champion a deal across?
Yeah, so I think it starts really with the first meeting, and I really wish founders were also doing some homeworks around who they're actually talking to, looking a little bit in our portfolio to see if there is any synergies or any overlap with their startups and companies we have invested in. And so meaning by that we would have expertise in some sectors that we would be happy to share with them. So I think it really starts with this. And then I guess it's, we have a very, maybe not so standard IC process, because we would have one internal IC, but then we would have the whole partnership to go and spend like a day with the founders. So to some extent, I will not be the only one pitching and selling the investment to the partners, because the founders will really have like a day to sell to every managing partner at Jungle. We would be typically looking for complementary skill sets between the different founders and co-founders. We'd definitely be looking for their learning agility and how they are also, going through tough phases. Because obviously investing in a startup takes, it's a long journey. We'll be working together for 3, 5, 6 years, and we want to make sure we're investing in people who can, go through the ups and the downs of their own entrepreneurial journey.
Thank you, Alice. T?
Sure, I mean, I definitely absolutely agree with Alice. And I think, for us, when you think about the first meeting, which Alice mentioned, I think it's really important to think about when that first meeting is. So we really like to build the relationship with our founders very early, and in this case probably just multiple months before they really need the money. Because we feel like, I think, each meeting along those points is really kind of a data point for us as well. So even though we really focus on Series A, I personally like to meet the founders since basically when they're raising seed. And at that point, we really establish a point where, okay, let's touch base every 2 to 3 weeks, see how your ideas or businesses develop. And in that case, basically when they're ready to raise the next round, we're actually right there. We know the company already, and we've just done significant due diligence so that we could move very quickly as well.
Fantastic. So we've heard from Alice, it's really around understanding the audience and looking for the synergy and looking for the right fit. It's not just looking for the money, so don't spray and pray, I guess. And then from T, we've heard about it's connecting the dots, so looking at developing the story over time. And I guess, would you agree then, whether you're officially fundraising or not, you're really always fundraising?
Well, pretty much, because I mean for us, right, when you're looking at the very early stage, of course we look at the market opportunity, we look at the business model, but a lot of what we're investing on is on the entrepreneurs and the team itself. And I think the ability to kind of take in the, the traction or the numbers or any information, data that they have and process it and say, well, what kind of decision, what kind of game plan do we need to have next? That's why we want the different touch point, because observe over a longer period of time, because then that allows us to evaluate that aspect of the business better.
Great, thank you. Teaser.
For me, there are 2 items. For Indonesian startup, I think I agree with you guys that the first important thing is the first meeting. 3 of us, actually the general partner, have to size up the personality and the motivation of this founder. It's important for us to meet them face to face, and also to understand the motivation why they want to do this. Because at the end of the day, in this kind of investment, we not invest in the product, we invest in the person. And we believe also in Indonesia. Indonesia is a large country, but then the academic situation is not as good as Singapore, for example. So we have to understand whether they really have a good business model, address the problem in the market, and whether they have the capability to do it. And the second thing is we also invest in global startups that want to go to Indonesia. For that, again, the first meeting is important. We have to meet the founders, but then we also want them to be somewhat the winner in their own country first. Because if they don't know how to solve the problem internally in their own country, why move to Indonesia? Yeah, that's it.
So what I'm hearing a lot is the first meeting matters, but let's be practical about it. I'm a startup. I'm passionate about what I'm doing, and I'm just having a bad day. And, you know, I'm meeting you and I'm thinking, wow, you know, you're going to make my dreams come true because you've got the check size. And so I absolutely failed the best meeting, or my best chance with you. And what can I do if I've failed that first meeting?
If you fail the first meeting. Okay. No, for us, it's actually that the process is quite, it can be a long time. So for us, it's like a dating process. Normally when we invest, it takes several meetings before we finally invest in the company. So the first meeting, although it's important, it's not the only meeting. It's not the solution, the end of the journey. Because normally we will give feedback to them, and it depends really on them, how they react on it, how they react on our feedback, whether it's positive, negative, whether they take any action. That will be reflected in the second meeting. If there is nothing changed, of course there will be no third meeting. But if there are positive development, then the meeting can go on to maybe investment.
Thank you, Teaser. And Vadim, how do we then make sure we have a great first meeting with you?
Look, being like so well known, like Vickers, we're not hunting for deals, we are bombarded by deals, and like we see maybe 6,000 deals a year. There is every day I've got at least like 3-4 pings through LinkedIn. Okay, have a look at this, have a look at that. We start our investment process very simple. We divide all decks into piles and then throw away one because we don't invest into unlucky people. Like joke aside. So we, like obviously we've got a very thorough due diligence process, and we pay lots of attention, and he said, into entrepreneur. So, but we doing things like quite different. For example, we invite entrepreneur with his wife and children to stay at the house of one of our partners. Our partners, wealthy guys, they've got a few houses here and there. So like either Morocco, San Diego, Penthouse and Sentosa. So they're staying for a long weekend with their wife and children, and they think that just got free holidays. But actually it's a part of due diligence process, because like what you see in a boardroom in these 2 hours that they are presenting to you is just like a little part. And you're supposed to stay with this guy like for 10 years, because we are a 10-year fund. So it's longer than marriage. So like average marriage like 7.5. So you're supposed to pay more attention and more effort choosing this entrepreneur than you're choosing your wife, because you can switch your wife more often. So like obviously these guys are staying for 2-3 days. We're observing them. What do they do in the morning? Do they sleep till noon, or do they jog in the morning? What they drink for breakfast, vodka or orange juice. So like from these little pieces you've got like understanding of this, deep understanding of this person. Are they capable to execute this strategy? Because like if product is wrong, they can pivot. If market is not ready, it's like a long story, market might cure. But if you choose the wrong guy, like you're dead. So like actually we've got like couple failures when entrepreneur died. Actually like 2 founders of our companies died because of stress. And we are not investing in young guys like university dropouts. Probably average, because look, we are a deep tech fund. If you are next Theranos and you are like a Stanford dropout, I guarantee will not invest. Because you're not supposed to be so smart to understand deep technology. Like average age of our entrepreneurs like maybe 40 years old. So like a much move in their companies. The guy is like 55. Like we've got FX trading platform. The founder used to run like FX trading for INZ. So this is like a mature people who know things or two about business that they're doing. This is why we are confident that they will be able to execute. So this is my 5 cents.
Thank you very much. And I thought it might be interesting and entertaining if you know, anyone on the panel had some, you know, #1 big mistakes, or the most comical or most stupid thing that a founder has done when they're actually pitching. So do you have any, you know, funny stories or anything that someone has or some team has done that they should categorically not do, or mistakes that you just find time and time again? Alice?
I think it happens once where actually the founder thought he was in front of another VC, So obviously not having done his homework properly, and it took him, a few minutes to actually adjust and think, oh, this is absolutely not the person I thought I was meeting. But eventually, it turns out, it was a good startup, and we continued the discussion many times, yeah.
We're definitely going to come to you guys to pitch. T?
Well, this doesn't actually happen to me, but it happened to one of my portfolio companies where they were working out of an office in Tiong Bahru, and they were actually unaware that there has been a cockroach infestation in one of their meeting rooms. So during one of their investor meeting, there was a cockroach attack, at which point the investor actually had to jump onto the table to escape from the cockroaches. Fortunately, they were still interested in the company and went on to actually be part of a $200 million plus round for that.
A nice story. Teaser.
Well, what happened to me was when they came to me, they thought that they mentioned a different VC name. So they didn't do the homework, and they thought I was with somebody else. So, but then it's okay. I mean, I have no hard feeling, but just that I know that they are not doing a good homework, and it says something. Yeah.
So, Vadim, you've talked about marriage, death. Are we going to touch taxes, or?
Look, we are investing in deep tech, and usually these guys are genius. And look, genius is a borderline of craziness. Some of our founders, they're a bit strange people. So one of the founder, he is not wearing shorts because he feels that it's like suffocating him. He travels always with his own pillow because he can't sleep on anything else. We are happy to accept strange people because, as I said, they're genius, and you understand that genius are strange people. So we are paying more attention to technology, and this genius, they might be not the best CEO for the company. Eventually they might be replaced by a professional CEO. For example, we've got one CEO for our company. He used to be a chief of president administration of President Bush. So as a CEO, you can't, obviously he's not an entrepreneur. He can't invent anything. But as a CEO, it's the best CEO you can imagine. So we are happy with crazy people.
Fantastic. Alice, any secret tips? What's your number one tip to get funding?
As a VC looking for funding, or as a startup looking for
As a
funding?
startup looking for funding.
Because VCs are also always looking for money.
Correct.
I think there's a lot of merit in persistence. So building the relationship early and trying to approach a VC on various occasions, because there would be cases where it might not be the right time, but you're starting the relationship and you're building something. So that's very helpful, and it goes back to the learning agility, because you may meet someone in Jan, you share notes, and then you see them 6 months later and they have totally changed. You also have changed. You've seen a lot more companies. So I think it helps to keep track of what's happening and to engage in a better, more complex relationship.
Thank you. T?
I would say the number one trait I probably look in an entrepreneur after I've been investing for about 5 years here is probably humility. I think there's a lot of founders who come pitch to us, and obviously they're very confident, and I think they felt like they need to project a certain kind of certainty or knowledge of what is actually going to happen in the next 1, 2, 3, 4 years. But I think the reality of the business that we're in is that it is very dynamic and there's a lot of uncertainty. So I think acknowledging that, and I think remaining dynamic and flexible enough to say okay, this is what we're gearing for. There are different factors that could obviously prevent that from that happening. If that happens, this is our plan B, or this is a different strategy we could execute. And I think that ability to, I think, embrace uncertainty. I think the world that we're in is very important, versus coming in and saying okay, I'm gonna 10x my business in the 12 months and I could guarantee 100%, which to me just seems unrealistic.
For me, I think different venture capital, they have different philosophy, they have different focus And I think for the startups, before they meet the investor, the VC, or whoever they are, they should do their own homework. Check the website at least so they know what kind of interest the focus of the this specific VC. And they could also contact the portfolio of the VC and see how they can, how this type of VC actually works and what is expected. And then maybe the most important things, they have to be ready whenever during the question and answers during the first meeting, because if they are not passionate, normally they don't know what to answer about the problems when we drill them hard questions. Yeah.
Thank you. Vadim.
I think we're hunting just for different animals because like most of the deals that we're investing, they're heavily oversubscribed, and actually we need to convince these people to take our money, saying that, look, my money is better than yours. So like, for example, our most recent deal, the technology speak, not entrepreneur. So we invested in a company which is making synthetic vaccine. So you know, vaccine, it's usually have to be kept in a cold chain, you have to keep it refrigerated to be alive. This vaccine, it's a synthetic. It's like aspirin tablet. You can keep it on a shelf like for 10 years. You can actually mail it because you don't need a jab. It's a micro needles. You just stuck it to your skin and you're immunized. So the first drug is going to be vaccine from all mosquito-borne diseases, one jab, from dengue, Zika, etc. So this guy has a queue of people willing to give money to him. So we need to convince him that we are better than others, that we, like Finian Tan used to be on a national health board, he knows how to deliver medicine, and he was on a national cancer research, he knows deep tech in medicine. So we need to convince people, and we raised for another biotech company in our portfolio 600 million. So we like this complexity, and we have two people who can talk to this entrepreneur, to this scientist on the same language. Because it's so complicated that this professor came to pitch to us. So he made his speech, and like none of us understood what he was talking about. And then Dr. Lim, our colleague, came out and translated to the a lame language, which half of it we understand. But entrepreneurs appreciate very much that we have people in our team who can actually understand and talk to him at the same level, the same language with the same understanding, deep understanding. He said, look guys, you are the first VC that I'm talking about and who are actually able to understand what we are doing. Because people are asking about business model, etc., but they are not capable to understand mechanics of this vaccine, how does it work. This is the beauty of having like these smart people on board that you can talk to entrepreneur. But for us, it's in more cases, we are convincing people to take our money rather than they're convincing us to give them.
Fantastic. So that brings me to a very interesting point where in terms of generating that alpha, generating those oversized returns, a part of it is finding the right deal, but how much of it is, finding that diamond in the rough? I mean, how much is it, what are some factors that, maybe a founder comes in and, A, B, and C is not there, but that's okay, you can work with. What are some of those A, B, and C's? And, let's live in the real world. If someone had A, B, C, D, E, F, they're probably, oversubscribed, probably too expensive, or something's not actually real. So maybe we can touch on that. I mean, Alice, what maybe is one or two things that are forgivable and that you could work with, and that, the reality is you expect. So T touched on the fact that you can't have 100% conviction that the market will turn out a certain way. What are some of those things for you?
I think as long as we are convinced that the team would be able to pivot when it's required, we can definitely be a little less strict on some other things. Obviously, because we invest at the Series A and B, we will not be taking a lot of the technology risk. So, we would be mostly investing where people have figured out their product market fit and they already have some traction. If the traction is not enough to be, a typical Series B, that's it can be okay as long as we're convinced that the team is there. It's okay if they don't have all of their C-level executive in place, as long as we know that the co-founders are good enough to attract and retain top talents, then we can help them to actually hire the next level of people in their team. So I think it's we never see like 100% green flags and all the check boxes. But definitely if the team is strong enough, we believe in the market to be a large enough and untapped market, and the company has built defensible moats, then it's okay to take on some other risks.
Great, thank you. T?
I think it's around, the long-term vision of the business, because I think everyone, obviously, a lot of entrepreneurs that we, meet and interact with have very big vision, and I think a lot of times they also look to other successful companies abroad to say, hey, is that who we want to emulate or, build our business model around? I think just to even come back to my earlier point is that, again, this world and this business is actually very dynamic. So I think allowing for that shift is very important. And for example, for one of our portfolio companies, Zilingo, which is currently about a $950 million company, I've worked with them since they actually launched the business about 2 to 3 months in. And at that time, they really were just a B2C fashion marketplace. And, to basically go through the journey today in the past 3 years to really become, a business that not only look at the B2C fashion marketplace, but going back into the supply chain and thinking about how you could disrupt the entire, manufacturing, distribution, inventory management to distribution and solve all those problems for the merchants. To be honest, did they know that they were going to get to this place when I first met them? Absolutely not. And I think that's a process that we work directly with them together to say, all right, now that you've starting to get more data around the business, where do the opportunities lie? And I think the one thing that's always kind of grounded all of us to be able to have this kind of exploration of the direction that the company take is that the company itself has always been fundamentally very strong on an economic basis. So every single time that we think about expanding or growing the business, it was really, the GMV growth, for example, was never at the expense of contribution margin. So as long as we feel like the company is very disciplined in terms of their spending and the way that they're acquiring customers and grow the business, we feel like that gives enough foundation for them to explore the different avenues from which they could continue to develop.
Thank you. Teaser?
Yeah, thank you. I think, when everything is not on the check, the tick box are not checked. So I think this is where the GP skills really required. I mean to differentiate really whether it's a good investment or bad investment. For example, when I invested in a company called Alijasa, they actually came up to me with a totally different business idea. And we say that, we cannot invest in you guys because we don't believe that it will survive. Your customer acquisition is too high, and this is where actually the first meeting didn't stop at the first meeting. They came back to us. We told them, hey, why don't you just focus on certain things that's recurring? And they came back to us, and then they actually follow up the idea, and then somewhat they are successful enough. They won 3rd place in World Cup Startup in the US. And subsequently, we invested in them, and within the 9 months, they actually grew from revenue 5 times, and also they are actually in laundry business. They grew from 30 laundry partners to 2,700 laundry partners in 9 months. So this is the process. Actually, takes a lot of time. It involves a weekly meeting with them in the very first month, because we are quite serious when we want to invest, and we spend effort and also time to actually spend time with them. But then, of course, after a while, then we let go them to actually execute on its own.
Vadim, I just can't wait for what you're going to say next.
Look, it's a very, very good question that you ask. How do you find and how do you judge that it's going to be a diamond at the end? We never bet on market. So if you came to us with a new iWatch, we will never touch it because we don't know whether people are going to buy it or not. You come with a new social network. Look, we don't know, we are not have a crystal ball whether like US teenagers going to pick it up or not. Like if you come with the next grab, say, okay, Vadim, I need $1 billion a year to burn just to make successful, we will not touch it, never touch it. But if you come with a technology, for example, most recent example, we invested, Singaporean company, RWDC, it's a names, Ronald V and Daniel Caraway, RWDC. It was in Straits Times, like I think last week. So it's a biodegradable plastic. The market is unlimited. So, you know, like everyone is banning like single-use plastic. European Parliament took a law that like single-use plastic is banned from 2021. What are all these people going to do like Tetra Pak? You know, you are buying a juice, there is a straw attached. And you know, the pack itself, there are three layers of plastic inside. If they can't replace it with something, they're out of business. All these people knocking at the doors of our little startup, they're ready to take as much of their product as possible. It's not a little startup anymore because it's like $200 valuation. So, but like this is unlimited demand for their product. This is what we are looking for. Or cancer drug. We invested in a company which is currently developing 8 cancer drugs. It's already in a human clinical trial. It's a large drugs like breast cancer, lung cancer, pancreatic cancer. Look, people are ready to pay more for cancer drugs than for iPhone. So this company is supposed to be a $1 trillion company, not Apple. So we are always betting on market. We don't bet on technology. So obviously, if it's already proven that it works, it will be already $1 billion company. So it has to be risk, but it has to be risk in technology that we can assess. And we can put a price on this risk, whether it works or not, but not on the market.
Thank you, Vadim. And there's one more question I've got before we get to Q&A. And we've heard from our fabulous GPs, which are responsible for some of the biggest centaurs and unicorns that we have today. And in summary, what we've heard about is build the relationship, be agile, know who you're talking to, and of course, it's okay to be a little bit crazy. But one of the things that I think is important to talk about, and very much, is that if you think about the entrepreneurs, you know, they are really the unsung heroes. They're the ones that have statistically given up solid careers and have made a statistical choice to chase a career in startup, which is risk adjusted. You know, studies show are not as rewarding as the startup path. So I want to ask another question. I think fundraising can be one of the toughest things to do. You're busily running your business as well as actually raising. So some of the tips, you know, how can the founders stay sane in this process? How can they look after themselves? Because really, you know, without the founders, we haven't got this amazing miracle that we see in Southeast Asia and this technology-driven response to solving the problems and improving the lives that we have today. So Alice, what are some of the tips you have for founders so that they can stay sane and stay in the journey, which is more like a marathon than a sprint, right?
I think you have to try and leverage people around you. You know, if you're a founder, you're lucky to have co-founders, to have investors, your family. So really try to get help in various formats and leverage people's knowledge, network, and expertise. Because there will be days which will be tough. If you can try to delegate some elements to someone else, and we are happy as a VC to really build a very close relationship with our founders, and there's a lot of trust, so you know, we're available for them, even in the tough times, and really trying to work through challenges together, and you know, just try to leverage everyone around you.
Thank you. T?
Yes, I agree. I mean, I think, you know, as when an entrepreneur go out to raise funding and I think build a business, you know, I think the pity is that, like, unfortunately, you know, these entrepreneurs, a lot of time, what they're really passionate, interested in is actually operating and building the business. But when you're actually the CEO, I think, you know, you actually number one priority is actually make sure that there is enough cash in the bank to continue to operate their business. So I think understanding that fundraising is a big part of their job, while at the same time you still have to have a company that it's still operating and growing enough time for the fundraising to be plausible. I think, again, having enough people to support you beyond just, you know, just your teammates, whether it's, again, co-founders or other more senior executive. I think that's very important. And I think it's on us as an investor as well to be able to help these entrepreneurs manage the fundraising better. And what I mean is actually just how we could be actually more direct in our feedback of the companies. I think we've been on the other side where, I'm cursing raising my fund right now, and we understand the frustration of being the one asking for money, right? Because you want the other side to be direct and be able to tell us directly, like, we're considering this, we're not considering this, how can you not just also have us tag along and give us some false hope on whether or not this money is going to come through in the first place. And I think that's the least that I think as investors we can do to a company as well, is to help them manage their own expectations so that they could run their own process efficiently.
Great. Teaser.
I think the first thing they have to do is they have to be honest to themselves so that about their own situation they are going to be in. And they also have to express it to their own family support system. And because if they are not being honest, they will not be able to accept all the situation that's coming along and all the challenges. And the other thing is sometimes we have the founders or the startup owner, they have their own belief. But then they have to still believe on whatever they believe on. However, they should not close the feedback from wherever they hear. At the same time, they shouldn't just easily swayed by all the feedback they hear from the investors.
I think our case, again, very different. When we're investing, first thing that we're saying to entrepreneur, you don't need to worry about money anymore. You are good at drug discovery, do your job. We will raise money for you. So for our biotech company, we raised 600 million, didn't charge a single cent. So every time when we are talking to our LPs, we are pitching our companies. We are organizing LP conference once a year in some nice places and inviting our LPs. At this LP conference, we're inviting 10 of our portfolio companies. They might not raise the money right now, but they might raise in the future. So they're all presenting for our LPs. And by the time when they start fundraising, the LPs already know this company, they already spoke to entrepreneur, they're ready for this moment. So most of our companies, they're co-invested with our LPs. So we are trying to relieve our entrepreneurs from the job of fundraising. When you've got enough money, you're comfortable and you can concentrate on your job to develop your company. You don't need to be worried about whether I have money to pay salaries to my employees. So we are trying to relieve them from this worry. So this is our little secret sauce.
Thank you, Vadim. And I'm delighted to invite you for Q&A.
May I ask a question to the audience? Please raise your hands who think that it was the best panel of the whole conference. Very good, thank you.
Thank you very much for that. So that's the end of question time. And thank you very much for being here. And we'd like to invite you to the conversation. So is there any questions and answers that we can facilitate for you? Any questions from the floor, please?
Are we so boring?
Well, I'm sure that you'd be happy to join me in thanking our panel. They will be around if you want to grab them for a conversation afterwards. Again, thank you very much for being a part of the conversation.